Artificial intelligence does not run in the cloud. It runs on land, on electricity, on cooling systems, and on debt. This is the central financial fact of the AI era, a truth that technology companies would prefer you not understand too clearly, because it reveals that the digital economy is not weightless at all. It is anchored to the physical world by steel beams, copper wires, and the most concentrated form of industrial real estate ever built. The cloud, that ethereal entity we imagine hovering invisibly over our devices, is in fact a network of massive concrete fortresses, each one a monument to the physical cost of the intangible. The casual observer sees a server farm, a row of blinking lights. The financial mind sees a toll bridge, a machine designed to convert a river of capital and a torrent of electricity into a predictable, annuity-like stream of future cash flows. The question is not whether artificial intelligence will transform the world. The question is, who will own the physical infrastructure that makes it possible, and what that ownership actually costs? To understand who is playing this game, one must first look at Northern Virginia, a region that has become the most important data center market on Earth. It is not because the technology is invented there. It is because the land is flat, the fiber routes converge from across the Atlantic, the politics are favorable, and the local utility has been willing, for decades, to build the substations and transmission lines required to feed the machines. Equinix and Digital Realty are the public market giants of this world, the landlords who own hundreds of facilities across the globe, collecting rent from thousands of tenants. Blackstone, the private equity behemoth, has poured billions into data centers, treating them not as technology but as infrastructure, as essential as pipelines or ports. The sovereign wealth funds of the Middle East and Asia have followed, seeing in these buildings a durable asset that can generate stable income for decades. And then there are the cloud providers themselves, Amazon, Microsoft, Google, who have constructed their own hyperscale campuses because they understand that compute is not a cost of doing business, but the core of their business. These are not the same enterprises. A colocation landlord and a cloud provider operate under different financial logics, and understanding that distinction is the first step toward understanding where the real money is made. The simplest way to understand the ownership structure is to separate it into 4 distinct models. The first is retail colocation, where the owner rents out individual cabinets, racks, and cages to hundreds of smaller tenants, each paying a monthly fee for space, power, cooling, and network connectivity. This is the closest to traditional commercial real estate, a diversified portfolio of tenants where no single customer can destroy the business. The second is wholesale data centers, where the owner leases entire data halls to a single enterprise or cloud provider under long-term contracts that can stretch for a decade. This model offers greater stability and lower tenant churn, but introduces the risk of concentration, where the loss of one tenant can leave a massive facility empty and unprofitable. The third is the hyperscale campus, a sprawling multi-building complex designed specifically for the world's largest cloud providers, where the scale of investment is measured in billions and the tenant base is often a single name. The fourth, and most powerful, is the cloud-owned data center, where Amazon, Microsoft, or Google owns the facility outright because they have decided that owning the physical asset is cheaper, over the long run, than renting it. And because control over the infrastructure gives them pricing power over their own customers. The primary source of revenue in the colocation model is recurring rent. The tenant pays a monthly fee based on the kilowatts they consume and the space they occupy. But the true genius lies in the layered tolls. The data center owner charges for the rack, the cabinet, and the secure cage. They charge for the power feed, the backup generator capacity, and the internet bandwidth. They charge for the maintenance of the physical environment, the air conditioning, the fire suppression, and the round-the-clock security. This is not a single rent but a collection of interconnected tolls, each one a small but critical revenue stream that transforms a concrete building into a powerful financial engine. In the wholesale model, The tenant pays a fixed monthly fee for an entire data hall, often with the power costs passed through directly, so the owner is insulated from utility price fluctuations. In the hyperscale model, the owner acts as a developer, building a purpose-designed facility and then selling or leasing it to a cloud giant in a transaction that can be structured as a sale-leaseback, allowing the cloud provider to free up capital while the data center owner secures a guaranteed tenant for decades. Before a single server is ever installed, however, the project has already consumed enormous capital. Land acquisition is only the beginning. The owner must secure a plot strategically located near major fiber optic routes, yet far from geological or social hazards, but the true cost lies beneath the surface. The owner must invest in the grid connection, the on-site substation, the transformers, the backup generators, the uninterruptible power supplies, the chillers, the cooling towers, the water treatment systems, the fire suppression network, the security perimeter, and the fiber entry points. Each of these is a separate capital project, each with its own engineering challenges and permitting requirements. The building itself is not a structure for human comfort. It is a high-security fortress with thick concrete walls, reinforced floors capable of supporting hundreds of tons of equipment, and entrances that are more akin to bank vaults than office doorways. The owner must amortize this massive capital expenditure over a long period, often 20 or 30 years, which means the debt service on the project is a fixed and formidable burden that must be met regardless of the occupancy rate. This is the financial reality of the data center, a project that requires hundreds of millions or billions in upfront capital, financed through a complex mixture of equity from pension funds and sovereign wealth funds, and debt from banks and bond markets. The AI revolution has changed everything about this economics. Traditional data centers were built around a certain power profile, designed for central processing units that consumed a predictable amount of electricity per rack. The new generation of graphics processing units, the chips that power large language models and generative AI, consume far more power. A single rack of AI servers can draw 10 times the electricity of a traditional compute rack, and it generates 10 times the heat. This has created a cascade of physical consequences. An AI data center cannot simply be an older facility with new servers installed. It must be redesigned from the ground up. The power density per square foot is so high that air cooling is no longer sufficient for the most demanding workloads. The industry is shifting toward liquid cooling, where chilled water or dielectric fluid is pumped directly to the server racks, a more efficient but vastly more complex and expensive system that requires the owner to install miles of piping and specialized heat exchangers. This raises the capital cost per megawatt of capacity, making each new facility more expensive than the last. It also creates a moat for owners who can build these modern facilities, because the older facilities, the ones built for a previous generation of computing, cannot easily compete. The financial model of the AI data center is therefore built on a paradox. The demand for capacity is exploding, but the cost of building new capacity is also rising. This has given the largest and most sophisticated owners significant pricing power. A hyperscale campus designed for AI workloads, with its massive power feed, its liquid cooling infrastructure, and its dedicated fiber connections, is a scarce asset. The cloud providers are desperate for this capacity, and they are willing to sign long-term leases at attractive rates to secure it. The owner earns money when the facility is highly occupied, efficiently operated, and financed at a reasonable cost. The tenant pays for space, power, cooling, connectivity, and reliability. Some power costs may be passed through to the tenant, insulating the owner from utility price fluctuations. The profit comes from turning fixed infrastructure into recurring contracted cash flow. This is the financial engine of the data center, a large upfront investment, financed with debt, that generates a stable and predictable stream of income over the life of the asset. At full capacity, the operating leverage is immense. The incremental cost of adding a new server cabinet is minimal compared to the recurring revenue it generates. This combination of high capital intensity, contracted revenue, and long-term leases is precisely what makes the data center so attractive to institutional investors. A pension fund with long-term liabilities sees a perfect match: a stable cash flow backed by hard assets. A family office seeking to preserve multi-generational wealth sees an alternative to the volatility of public markets, a store of value that is as close to a modern, high-tech fortress as one can find. But the risks are equally formidable. The most immediate threat is technological obsolescence. A data center built to support the density of 5 years ago is a suboptimal asset today. The AI revolution, with its demands for even more power-hungry GPUs, is forcing a constant cycle of upgrades. The owner must anticipate these changes and invest accordingly, or watch their facility become a stranded asset, unable to attract the tenants who demand the latest infrastructure. This is the paradox of the data center. The very technology that creates the demand also makes the facility itself obsolete. The second risk, even more fundamental, is power itself. A data center is a high-stakes wager on the continued availability and affordability of electricity. A sustained increase in energy costs, a regulatory carbon tax, or a simple grid failure can instantly erase years of profit. The industry's solution is redundancy at every level, leading to the third and most insidious cost: the construction of entire backup systems that are rarely used but must be maintained at immense expense. This is the price of the guarantee, the cost of the 5 nines availability that a bank or a government demands. The owner is not just paying for the electricity that is used. They are paying for the entire infrastructure that could be used in an emergency, a colossal insurance policy against a blackout. This risk is so profound that many data centers are now built with their own on-site substations, effectively becoming their own mini-utilities, a testament to the fundamental physical vulnerability of the digital realm. The risks multiply from there. Customer concentration is a constant threat. A wholesale facility with a single tenant is an empire built on a single relationship. If that tenant leaves, the building may require expensive reconfiguration to attract a new occupant. Lease renewal risk is equally dangerous. When a lease comes up for renewal, the tenant has leverage. They can threaten to move to a newer, more efficient facility, forcing the owner to offer concessions or invest in expensive upgrades. Grid and permitting risk can delay a project for years before a single dollar of revenue is earned. Water risk is becoming increasingly acute. Some cooling systems consume vast quantities of water, and in drought-prone regions, this creates local, political, and environmental pressure that can limit operations or drive up costs. Interest rate risk is a constant companion. Because these projects are debt-heavy, a rise in rates can make new projects uneconomic and increase the cost of servicing existing debt. Technology risk, the most existential of all, means that the owner must constantly guess what the next generation of chips will demand, a gamble that can make or break a facility's long-term viability. In the AI era, however, the most important bottleneck is not land or even capital. It is permitted, connected, usable power. The best sites are no longer just close to fiber. They must have access to large, reliable electricity supply, and they must have the political and regulatory approval to draw that power from the grid. This is the new scarcity. The largest technology companies are now competing with utilities and municipalities for the same limited resource. They are effectively becoming energy companies themselves, building their own substations, negotiating their own power purchase agreements, and, in some cases, developing their own renewable energy projects to secure the electricity they need. The data center owner is therefore not just a landlord. He is a power broker. He controls access to the one resource that every AI company needs more of, and he can charge accordingly. This is where the real margin lies, not in the building itself, but in the ability to deliver electricity to the machines that run the future. This is the hidden rule of AI finance. The digital economy looks like software, like code, like intelligence. But on the balance sheet, it looks like land, power, cooling, chips, and debt. The companies that control the physical bottlenecks will capture the value, regardless of which AI model wins the race. The data center is where the digital economy becomes physical, and in the age of artificial intelligence, the owners of that physical bottleneck may become some of the most important toll collectors in the world. They will not be celebrated like the founders of the great technology companies. They will not be featured on magazine covers or celebrated for their vision. They will be the silent owners of the infrastructure that makes the vision possible, collecting their rent, servicing their debt, and watching the cash pile up. The future may be digital, but the profits belong to whoever controls the physical bottlenecks. And the most valuable bottleneck of all is the one that turns electricity into intelligence.